This is surprising. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, what Bank of America and the other big banks just did is surprising. This is a move they're going to have to undo in the near future because they're facing stiff competition at the wrong time for the economy, which we're making the case today. Despite the Fed's belief that the economy is accelerating here, we have some new evidence which shows just the opposite of that. And are we about to see another fake payroll report on Friday? Well, we're going to make the case today of why there's a good chance that BLS is going to cook the books again. Let's over to Bloomberg, where we picked today's story up with the headline: B of A raises payout 9% after passing the Fed's annual stress test, as a quarterly dividend is going to go higher here. Now, this doesn't make a lot of sense because the economy is slowing, the banks are tightening lending standards, and what they should be doing is preparing for a wave of delinquencies that we know are going to lead to defaults, and they should be building their loan loss reserves. Instead, we see Bank of America and the other banks say, you know what, we're going to raise our dividend here, but what's surprising is what they're doing is going to have no effect on their stock. JP Morgan, Citigroup, Wells, Morgan Stanley, and Goldman Sachs all announced higher dividends after every lender subject to this year's Fed stress test passed the exam with no actual surprise. We knew they all were. In typical years, clearing the exam sets the stage for banks to return billions of dollars to investors through dividends and stock buybacks. Now, what's interesting about this is despite the fact that they're doing this, bank stocks are headed lower. Now, it starts to make sense. When financial conditions tighten, when they tighten the amount of lending standards and they create less money, well, what should that ultimately mean for bank profits down the road? Well, they should go down. So in the short term, they're all looking for ways to push out as much money to their shareholders, but it's not going to last. B of A's higher dividend will start in the third quarter, subject to approval by the board of directors, who will assume, because they're benefiting from this, will have no problem signing off. At current prices, the stock would only yield 3.3% annually. Now, that's the shocker here is, B of A stock, you look at these other bank stocks, if you want to be competitive in the marketplace, well, raising your dividend yield to 3.3% a year is nothing, particularly when the stock price is still heading down despite the yield here. The shares closed at $29 on Wednesday, leaving them with a negative total return this year of 11%, including dividends, and that just doesn't make any sense because their biggest competitor, the Federal Reserve, is paying money markets 5.05%. And of course, we know that the money markets have to take a little bit of profit on that. So the question is, are investors going to look at a safe, risk-free investment in the money markets backed by the Fed? Are they going to invest in bank stocks, which are paying a far lower yield, and as we've seen, are heading lower? And we're going to make the case again why they're going to go down even more, why these banks are going to be forced to cut their dividends in a big way. Each year, the Fed tests the banking giants to see if their balance sheets are sound enough to weather the severe stress in the economy and the financial markets. The results released showed that the biggest 23 U.S. firms can withstand a severe global recession and turmoil in real estate markets. But you weigh in the comments. Do you think that the banks can survive a severe financial crisis and turmoil in the real estate market? Well, I'm not so sure I agree with the Fed stress test, but I'd love to know what you think. Because here we can look to the minutes now, as Fed minutes revealed divisions over decision to pause in June. Now, I want you to set the stage here because, this is just not just the banks, being subject to the whims of the Fed and being in competition with the Fed. I want you to see how this flows into the economy as we get into the latest data here in a moment. But if you look now at the Fed, here you see the headline, we're going to keep raising rates. Of course, that makes B of A's increase in their dividend and the other banking stocks look almost nothing. I mean, if they really want to compete with the Fed, they'd have to raise their dividend yield to well over 5%, especially to offset the declines in their stock price. But you can see they just don't have the margin to do it, even though they need to. The minutes also showed that a large majority of policymakers, quote, almost all, agreed that more tightening will likely be needed this year. That, coupled with a reference to the importance of post-meeting communication or jawboning to clarify officials' intentions, provided ample evidence that the Fed likely isn't done. So you got to love the fact that, the Fed has a press conference, they put out all their material, and the key thing here is called forward guidance or jawboning, is to say, hey, you know what, in case we weren't clear at the press conference, which they rarely ever are, we all need to run out in the following weeks and make sure everybody understands that we're going to raise rates a whole bunch until they stop buying stocks and stop spending the money and inflation comes down. That's kind of the goal here, but the evidence and the emphasis is on this thing called forward guidance. Doesn't really matter much. Well, we've learned throughout history, well, regardless of whether the Fed talks rates into going, it really doesn't mean that that's where rates are going at all. And here we can see this is a challenge for the banks, and they're facing a battle with the Fed now as the yield curve gets even steep, or goes even more into negative territory, deeper inversion. As we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, and we can see that this is going higher, and it's now likely to go even higher. Remember, we look back to the recent senior loan officer opinion survey and said in the second half of the year. Now remember, this survey is a look back. Usually it's senior loan officers saying this is what we did the last quarter, and very rarely do they look ahead and say, hey, by the way, we're going to be tightening lending standards going forward, and if they do that, they're going to originate fewer loans. Fewer loans means the question is, how are banks like Bank of America going to afford this higher dividend yield? Well, perhaps it will end in layoffs. We'll see for sure, but I want you to see here now how this translates back, because the Fed is going to cause the yield curve, if they go through with these hikes, to get even more inverted. And of course, we know the deeper the inversion you get, the higher the probability of a banking crisis. And of course, it does make us start to wonder, is the Fed's intention here to cause a massive financial crisis at the same time they're trying to make a recession to bring inflation down? We really don't know what their agenda is. It's not something we want to believe they're trying to do, but all the evidence says, yes, that's what they're up to. A strong majority of committee participants expect that it will be appropriate to raise rates 2 or more times. Before it was 2, now we have more by the end of the year. Just remember, Powell just said it was 2 not too long ago for certain. Now it's 2 or more. There's 4 meetings left. Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Perhaps, Powell, because monetary policy has absolutely no effect on consumer prices, but don't tell him that. Look at the charts. It tells you everything. Here you can see the consumer price index in blue. That's shown on a year-over-year rate of change against the federal funds rate. And what I did is I circled all the peaks in the funds rate here. So you have a peak in the late 80s and then peaked inflation later. Here you have a peak before they cut and inflation peaked later. Then you have a peak here into the dot-com bubble. Inflation peaked again later. And lo and behold, I know this is surprising, ahead of the global financial crisis, the Fed cut rates, inflation still went up. It did that again going ahead of the pandemic. And now this time, for the first time in what we can say in modern history, the Fed almost has a credibility issue here, where they've got to keep raising rates until inflation comes down so they can say, hey, look, we did this and we were successful. And you know what? Correlation is not causation, and there is no relationship between the funds rate and inflation, as you can see on the chart, other than the fact that if you got to prove your worth, well, you keep hiking until inflation goes down, or you break everything, and then inflation will really come down. Officials supporting a hike in June cited tight labor markets and relatively few signs that inflation was slowing toward their 2% goal, according to the minutes. Some policymakers have expressed concern that core inflation, because we're moving the benchmark now, in particular, hasn't budged much in the last 6 months, but something that should have been budging in the last 6 months, at least to the upside, is your trading account. Taking a look at our CTA-Timer Pro, we're going to give you an update because the markets now are down pretty big today at the time of recording. But if you chase this tech rally, well, guess what? CTA-Timer Pro said you to start taking positions down here when no one wanted to. And if you didn't, it said, hey, you can buy this pullback because it said to do that. And then up here, we talked about this the other day. It said, hey, look, maybe you should start backing off your positions, taking profits, or worst case, raise your stop loss level up so you could sleep at night. And sure enough, let's look at these signals. Going back to January 9th, we were max short position. We said, when this starts reversing, start taking position, boom. And it did. Then on March 15th, what happened? That pullback, the machine started buying up out of that, and this report said this is what you need to do. And here it is on June 30th. We see this initial pullback. Now, this signal has reversed, but it's telling you that, hey, you should at least raising your stop loss level up. Don't let these profits go, because what our report does is looks at how these machines are positioned to trade the market and runs a historical overlay. And as you can see, it does a phenomenal job of giving you the signals. $30. Link in the description below. Get it while supplies last, because the economy is headed down, and at some point the markets will go with it, and you can watch that report will nail it every single time. Here we can see exports down, imports down. Of course, the Fed says there's no signs of a slowing economy, and there you have it. But now let's talk about this interest rate thing, because what I want you to understand is, why does higher interest rates cause the economy to slow down? And one of the reasons is you need a circular flow of dollars through the global economy. You need to see U.S. consumers borrowing money and buying foreign produced goods and services, causing dollars to flow overseas, and those dollars get recycled back to the U.S. When foreign investors and central banks buy U.S. Treasury securities. The government then gets that money and then spends it out in the economy, and again the cycle starts to move again. And so one of the challenges is, if U.S. consumers say, hey, you know what, I would rather actually park my money in, say, a 12-month or 2-year CD or some Treasury security, and I'd be really happy with that interest. Well, guess what? That means that money has no chance of cycling. Now, maybe it wasn't going to move before, but it certainly has no chance of that now. So let's take a look at why we're seeing these higher interest rates have an effect on both imports and exports. Here we can see the yield of 2-year Treasury securities against imports of goods and services on a year-over-year rate of change. And no surprise, as rates go up, imports go down. Again, it's a demand issue here. You start to see demand go away because money stops moving through the global economy. How about exports out of the U.S.? You see the same net effect. As soon as consumers here stop moving money through the global economy, next thing you know, the global economy starts to slow down. And that's exactly what we're seeing right now, is higher interest rates have got American consumers thinking about saving money rather than spending money at a time when we need to see people spending money. We can already look over at Asia. We've been talking about China. Their economy is slowing, not because of internal demand, which is part of their problem, but it's external demand from countries like the U.S. And all this tells us inflation's coming down, despite the Fed's belief it's not. And here you can see imports of goods and services against the consumer price index, both shown on a year-over-year rate of change. Imports are in blue. Look at that, imports leading the consumer price index down. And lo and behold, it does that virtually every single time. And now you can see the case why Powell's got this wrong. 3 more rate hikes, 2 more, maybe 1 more at the July meeting. But normally what we should be looking for at the next CPI report is the year-over-year rate change should go down, down, and down some more. And along with that, what we should see is an increase in layoffs, but perhaps, according to ADP, not yet. U.S. companies add nearly 500,000 jobs, most in over a year, showing a broad increase in hirings. Payrolls increased by 497,000 last month, making the biggest advance since February 2022, according to figures published today by ADP. It was more than double the median estimate in a Bloomberg survey of economists, because who would have ever guessed we'd have nearly 500,000 jobs created? It doesn't make absolutely any sense, because we've been watching the weekly initial claims kind of steadily tick higher, sitting around this 250,000 number. We'll look at today's here in a moment. The job gains were relatively broad-based, including advances in construction, trade, and transportation, and other service industries, with leisure and hospitality adding the most jobs since September of 2021. And here we can see the June payroll surge is ahead of the official government non-farm payroll report due tomorrow, but most of it is in leisure and hospitality. Now, what I find really interesting about this is I happen to live in the vacation capital of the world. Everyone wants to come here, and guess what? A lot of the leisure and hospitality jobs were hired months ago. Now, we're still seeing a few new people, or at least we're seeing some of those other people getting trained, but not like we saw before. But what's surprising being here is demand is actually going down. We're seeing the parks aren't as busy, the shopping centers aren't as busy, and around here in the summer, everything should be wall-to-wall people, and actually, it's not too bad, giving me kind of some suspect to what ADP's up to. Are they just cooking the books ahead of the BLS report? Well, we'll find out tomorrow for sure, but let's make the case of why this report is way too good. As Americans are working fewer hours, and that holds clues for the job market, as further declines in the average work week risks a pickup in layoffs. So here we have, one headline, look at all these jobs we created. Another headline saying, wait a minute, people are working less. So if you're working less, why would an employer be hiring more employees? It doesn't make any sense at all. Average weekly hours have fallen in 3 of the last 4 months, dropping to the bottom of the 34.3 to 34.6 hours range that seems to be the happy and healthy range for hours in the economy. Only happy and healthy if people are making the wage that they want to make. Of course, we know total compensation is going down as well, and that's not a good sign for consumers dealing with inflation. We may now be at an inflection point, she said, with a further decline would not only be concerning, but also suggest a real slackening in the labor market, a case, as many of you know, that I've been making and saying is absolutely going to happen. Now, let's look at the counterpoint to the ADP report, which I do think is highly suspect given the big number. Now, am I expecting a big number from the Bureau of Labor Statistics? Oh, you bet. It's going to be blowout. You'll watch and see. But let's take a look at the weekly claims where I think the real numbers are at. Here we can see initial claims that ticked down last week are back up, or ticked down the week before, now up 12,000 to 248,000. The ongoing continuing claims, and everyone says, look at that dropping. Well, it dropped a little bit more now into the high 1.7 million, but still holding relatively steady there. But total claims sitting at 1.7 million as well. The 4-week moving average is sitting at 253,000. As many of you know, I've been making the claim that once we sustainably break that, there's going to be some sort of inflection point that's going to drive that all higher. But this weekly hours work, which we'll get an update on tomorrow, I think is very telling about where these initial claims are headed and why the ADP report is totally wrong. And here you can see the average weekly hours of production in non-supervisory employees is steadily heading down. It was heading down going into the pandemic, and normally when it heads down, there's a good chance we're headed into a recession or some sort of soft landing. Here we see back in 1994. And what does that mean when hours work goes down? Well, one thing you can count on, the 4-week moving average of initial claims, as you can see, in each instance heads higher here, suggesting that the labor market is far more weak than the ADP report says. Where are all these people that are getting hired working? Well, the question is, why aren't the people working getting more hours? Do they not want it? Who knows the real answer? But I guess tomorrow we'll find out if the BLS is cooking the books, and you can probably guess there's a good chance they are. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.